Bismillahirrahmanirrahim. Assalamu alaikum dear viewers and students. In today's video we are going to cover the topic which is very useful and interesting. What is the difference between absorption costing and margin costing approach? So let's start. First we are going to be learn what is the difference between the two approaches in descriptive form. Then we will explain it more deeply with the help of an example or numerical example. Absorption costing, it is a traditional approach of product costing that includes both fixed cost, meaning fixed and variable cost of the factory overhead cost, which is an indirect cost at the time of calculating product cost and becomes a part of the inventory. Further, it is be noted that it is follows the principle of matching at the time of constructing income statement. Now come to the margin costing approach, and this approach emphasizes only variable component of cost even in case of FOS, factory overhead cost, at the time of finding product cost. The philosophy behind this approach is that fixed cost is of permanent nature. Even a single unit will not produce. It means that, let's suppose you have installed a machine in a premises with other equipment to produce some products like belts, jackets, bats, etc. But the cost that you have bear in installing and purchasing that machines and other equipment is the part of the your product cost, because you have been bear this cost even you do not produce even a single belt or leather jacket or bag. So these expenses or this cost cannot be vary with the volume of the production of units. This is the thing that I am going to be written. I have written here. Variable cost varies with the volume of productions. This is the reason that followers of this approach expense out this cost, which costs fixed factory overhead cost and charge to the profit and loss account. So this is a main difference between absorption costing and marginal costing. What is that? That is a traditional one. It includes all kind of cost into the cost of the product, but in case of marginal costing we only consider variable portion of the all type of cost, either the direct cost or indirect cost at the time of finding product cost, but we will deduct this fixed cost, fixed FOS cost at the time of determining the net income or net profit. Now we are going to move an numerical example to state in more depth. So let's this is the example. Company ABC produced 100 units each in first 3 quarters and sold 180 and 110 units at rupees 2400 in quarter 1, quarter 2 and quarter 3 respectively. Earned profit as follows: quarter 1 to 3 absorption costing 60,000, marginal costing 60,000, 48,000 in second quarter, 44,000 under marginal costing approach, and following third quarter in under absorption costing the earned profit is 66,000 and 68,000 under marginal costing approach. Now if you look at this table, you have been observed that when in first quarter when all the produced units are sold, the profit is same under both the approach. But when you are going to be sold less number of units, as you observed in the second quarter, the profit under absorption costing is greater than the profit under marginal costing. In third, when you sold more units than the produced units, then the profit in under absorption costing is less than the profit under marginal costing. Now we are going to have additional information, particulars of absorption costing, product cost for 100 units, 180 units. You see there is no separate cell as you can observe with the marginal costing 20,000. It means that in absorption costing, which is also known as a historical approach, we include all kind of expenses. So look at this, even fixed cost for 100 units, factory overhead cost also included into this one. But in case of marginal costing, we have definitely two components. One is product cost 160,000 and one is 20,000, which is related to the fixed cost of FOH. Now in third cell we have third row we have fixed FOH rate 200 per unit and the 200 per unit. Now we will move to the requirement. Reconcile the profit figures earned under absorption costing and marginal costing in quarter 2. Reconcile the profit figures earned under absorption costing and marginal costing in quarter 3. Describe the reasons of profit behavior under absorption costing and marginal costing in quarter 1 to 3. So let's move to the solution. Here is the part A. Now we are going to make reconciliation. Reconciliation means we are going to start with the balance profit earned under the absorption costing, and then finally we will reach to the profit earned under the marginal costing approach. So under absorption costing, the profit is 48,000. Now we are going to make an adjustment. As I already told you that in this figure 180,000 figures, all two type of expenses included. So what we need to here, we need to extract or deduct that portion of the closing stock which are 20 in total or in count from the profit figure to reach the profit earned under the marginal profit costing approach. Now here is a working look at this. Fixed factory overhead rate is equal to 200 and units in stock unsold 20. So fixed 200 unit is here. We are going to multiply this 200 units with 20. We will get 4,000. This is the portion of the cost of closing stock that have included into this one. As because of this, we have earned more profit in under absorption costing. When we are deduct this figure from this 48,000, we will reach the same amount of profit that we earn under the marginal costing approach. So what we are going to do, when number of units sold are less than the number of units produced, we are going to subtract that portion of the fixed factory overhead cost that related to the closing stock from the profit figure of the profit under absorption costing. Now move to the part B, where we are going to make a reconciliation in where the company sell more units as compared to the produced one. As we know that the number of units produced in all 3 quarters are same, which are 100 units. But look at this, in quarter 3 we are going to sell 110 units. This means we are going to sell 10 more units as compared to the produced units 100. So first point to be taken into account is that from where we will get this 10 extra units. You see in the quarter 2 we have 20 units in stock. So from that stock we are going to use 10 units extra to make sale of 110 units. So in this case, look at this, we have included 100 units of cost of 100 units, both component of including direct cost and factory fixed FOS cost of the factory overhead. So what about the 10 extra units? So here is need to be add back the that portion of the cost which is related to the fixed FOH, which is equal to 2000, and we will reach the profit under marginal costing 68,000 in this way. Now look at the working fixed FOH rate is 200. Now units in stock, no units, units extra units sold, units sold 10. When you are going to multiply 10 by 200, you will get this 2000 value of the closing stock in terms of fixed FOH. When you will add back this 2000, you will get the 68,000, which is exactly equal to the profit that we earn under the marginal costing approach. Look at this. I am going to show you the table one time more. Look at this. Here 68,000, by adding 2000 into the profit of the 66,000, we will get the same figure. Now come to the part 3 and describe the reasons of profit behavior under absorption costing and marginal costing in quarter 1, 2 and 3. So in part A, as all produced units have been sold, therefore the earned profit is same under both the approaches. In part B, as number of units sold less than number of units produced and fixed FOH of 20 units also included in cost of goods sold, as per absorption costing approach, we are going to be include all the components of the cost at the time of calculating cost of the product or product cost. So it means that here is a need to be deduct that portion of the fixed FOH of 20 units which are unsold from the earned profit of the absorption costing approach. So while in marginal costing approach, we are only considering variable component of FOH, and we leave the fixed portion of FOH, and we will deduct it later to reach the net income or net profit of the company. Now in part C, as then more units have been sold as opening stock than produced units, therefore need to add back fixed FOH of these 10 extra units into the cost of goods sold to raise value of cost of goods sold. The reason is that because actually in quarter 3 we are going to produce only 100 units, and these 10 units are belong to the previous quarter, second quarter. So need to be add back the fixed portion of FOH into the cost of goods sold to reach the actual value of the cost of goods sold, and finally profit under the absorption costing that matches the profit earned under the marginal costing. I hope you will enjoy this subject or interesting topic. If you have any question or query, please ask me in the comment section. Thanks for watching.